The broadcast is now starting. All attendees are in listen-only mode.
Good evening. Can everybody see my screen and hear me? If you can, just type in a yes or perfect. Thank you, Brad. All right, great. Let's go ahead and get started, guys. This video is certainly being recorded, and recordings will be uploaded later once it converts from the format the GoToMeeting uses into a format that's usable in other platforms. All right, so usually what we do in our beginner circle webinar is we give precedence to questions about applying Elliott Wave, where to find things on our different sites and services, and then we use those questions about Elliott Wave and applying Elliott Wave as precedents as we go through and take a look at the counts in various markets and things that we normally cover, looking at some of the major indices and then a few of the commodities that everybody clamors over, as well as the mining stocks and so forth. So I have here the ES futures. The ES is the mini contract as opposed to the actual S&P futures contract. Very few people trade the S&P futures contract. But this is the futures of the S&P for all practical purposes. We're going to shift in our explanation here. We're going to look at something at also the S&P cash index, just to see that sometimes there is a little bit of nuance. But for the most part, the only difference between the ES futures and the S&P cash index is that the futures are open a little bit more hours, and the volume, and certainly in terms of options and just the amount of money traded, is certainly significantly more for the S&P itself. But the futures do allow us to fill in some of the missing data because we have sometimes different highs and lows are hit after outside of regular trading hours. And so it makes sense to try and fill in some of those things that we're missing. So what we're looking at here is a 4-hour chart. My 4-hour chart will allow me to encompass data. I mean, if I slide this all the way over to the side, then I can look back. I mean, even if I go all the way so the price is as far to the right as I can do, then I can go back pretty much a year. But when I frame the views for my chart, I like to have probably about 61.8% of the rectangular chart window. And that's an approximate, but it's pleasing to the eye because we know that our 61.8% retrace is a magical Fibonacci number that has a lot of aesthetic properties. So I tend to provide some amount of historical price pattern when I frame a chart to print to show you guys, and then show some open space for where I see price going there. And here we have a 5-wave move up off of the March low to nominal new highs over the highs that we struck in February. Sometimes you'll see this is counted as a B or an X wave, and the actual top of the primary wave 3 is back here. But I think for most of our purposes, it really doesn't matter that much. A lot of things did top here and have a very sharp ABC down for their wave 4. But we have 5 waves up and are looking for more of a wave 2 retrace. Now, when we were initially counting this off the low, a more proportionate normal extension for wave 1 of a bigger 5th wave, and here I'm going to zoom out so that we can see the larger structure that we're looking at. I need to go to a weekly to get everything in, is off of the 2009 low. We have a primary degree wave 1. This entire move either to here, and this is an expanded flat, or up to here is the primary wave 3. And then we are working on the 1-2 start of our primary wave 5 that should get us some very, very nice extension off over the next several years, ideally getting a wave 2 retrace. So this will complete 5 waves up off of 2009. We are just in the first part of that larger fifth wave. Now, ideally, your wave one of a fifth wave will not make a new high. Because as I mentioned to some folks a couple months ago, the risk when you make a new high as 5 waves up off of your fourth wave is that there is a risk that this counts as all of that fifth. But with so many other individual charts that Garrett and I follow in stock waves and all of the sectors, most things, there's a number of things that did not make higher highs, and a lot of things that did make higher highs count actually as wave one of a larger third and not a fifth wave. So there's still enough evidence that we can give this the benefit of the doubt that this move off of the June low was just an extension, and our actual count, instead of this being 3, 4, and 5, this is 3, 4, and then this is an extension of the fifth wave for the top of that wave one. Now, the other alternative that we can come up with that's a little bit more immediately bullish is that this was all of a very shallow parentheses wave two, and this move up off of June is wave one of the 3. And so if we hold a retrace in the 3100s, instead of that being A of an ABC move for the wave 2 retrace, then we can have that ABC be wave 2 in the more aggressive third starting off of June. But what I want to focus on today is this structure right here, and that in either of those counts, whether we're going to count, and I'll go ahead and add that green wave 2 here. So put a wave 2, we'll bump it up so that it is the parentheses wave 2 degree, which is intermediate. That's 1 degree inside of the circle 5. So that would be the 2 here, implying this was the wave 1 top, and that this is a 1, 2 inside that parentheses wave 3. But in either of those, we're looking at a corrective bounce off of the initial move down in September that looks almost textbook as an ABC flat, setting up for a drop down towards the 3100s, and ideally the lower portion of the 3100s. And that will either count as this A wave of a little bit more of a retrace for wave 2, but being due for a bounce in a B wave that could even get higher and end up being more of a wider flat, although I'll talk a little bit in a minute about why I like the structure more like this that comes down into early November. Or this is the wave 2, and it will blast past this B wave target in the start of the third of the third. So either way you look at this, a drop down into the 31s is an excellent opportunity to be adding long exposure to equities. If we clearly only have a corrective bounce as a B wave, you still had the benefit of a 6+%, 5 to 7% plus move for a B wave bounce, and a clear indication that it looks like a B wave, and you can tighten some stops, trim, hedge, whatever you want to do. But an ABC structure into this support region would be a tremendous opportunity to attempt a long. And then evaluate it as you go. If you are like me and you think that really this should just be the A wave, we get a B wave bounce and a C wave down of the wave 2, that's great. But I'm still going to notice a lot of stocks that look more like this is all of either all of this wave 2 here or all of the 1, 2, 1, 2 here, and those are going to be my primary candidates for adding longs in this region. This structure here that we're going to zoom in on and look at in just a minute, this very, very clear ABC flat structure, I think is the inverse version of similar structures that we've already had over the last several months. We had this very nice expanded flat structure that gave us a very high probability low setting up for a move higher in early April. That was, we put out another big list. Garrett and I put out another big list in our Stockwave service of a lot of really good buy opportunities, because after we got this initial move off of the extreme March low, we had a lot of things that were holding a very nice clear corrective retrace, setting up for at least a measured move higher. Then we got what looked like the top of a possible wave 3. We had another very clear ABC consolidation as a nice perfect flat, setting up for at least a move higher as what we were thinking would be our 5th. It turned out to be just the C of an extended 3, and then we got another 5th after that. But we did have, these types of structures are excellent structures to set up for another leg. Whether that leg is a 3rd wave or a C wave or a 5th wave, it really doesn't matter. This is kind of that ideal corrective structure that you want to look at as a trader. You can argue academically about the nuanced Elliott wave count at the larger degrees all you want. But as a trader, when you see this type of ABC structure inside of a consolidation that comes right to an ideal fib level, right here between the 382, 50%, and 618 as a perfect flat, that's your, bells should be going off, and you should be saying that's an excellent attempt to trade for a swing in whatever direction the swing is pointing to. So here's where I'm going to jump over to the nano count tab, and we can look a little bit more at the structure that we have off of this high and where we're targeting for that C wave down. And what I have labeled here is just an A wave, but as we saw in the other chart, it can be that green wave too. But what this low is really doesn't matter. What we have is this very clear, I'm going to zoom in just a little bit more so that we can see, first look at this structure in a little bit more detail. And then we can talk about the targets and implications of that. So this is what I would call a textbook ABC pattern in terms of a 3, 3, and 5. We had what got to enough of a retrace as a sharp bounce up here that we had a couple of consolidations and could have had this already as an A and a B and looking for the start of a C wave down. But when it got over some initial resistance that I posted about a few nights ago, then it started to make it more likely that we were going to target back up towards this low 3400s region as the alt in a wider B wave flat. I'm going to take that alt off because that's actually what transpired. But we do have this clear ABC structure in the A wave. We have what really should have probably held this low, but I think this is 1, 2, 3, an awkward 4, and a 5th wave down for the C of the B wave. And then we have 1, 2, 3, 4, and getting a little bit of extension today in that 5th wave up because it wasn't able to break any support to try and head towards that 100% extension for the C wave. This 3426, which we got very, very close to, not only is that the middle Bollinger Band here, but that is also the point where the parentheses C wave is equal to the parentheses A wave. And that is, one of the ideals that we look for within corrective structure. We also have confluence here with that being very close to a 50% retrace. And as I just mentioned, that middle Bollinger Band. So we have a very, very high probability setup of an initial move down, a corrective consolidation, and set up for at least a measured move, which sometimes I call a pirate ninja, just to be silly. Targeting the 100% extension of that move is around 3142 in the ES futures. The 1236 extension is 3080. And we also have the 100-day moving average at 3170 and the 200-day moving average at 3095. So this region, ideally coming towards at least 3142, is going to be the ideal target as long as the high of the day holds. It is possible to get a little bit more extension, but the reversal that we had off of the high of the day today really looks like it should be the start of a C wave down. So at this point, if that is taken out, then something else is going on, and we're just going to ratchet up new support levels to whatever low we get this evening before that new high is made, and that's going to be our new support for any further extension that would just have to label as GORP until it gives us a little bit of a clear idea of what it is. There are a few charts where this can count as a larger third. this consolidation is a fourth and possibly starting a fifth wave of a larger 3 inside of that primary wave 5, so they're further along. But most things that Garrett and I follow in stock waves, and most of those things we have isolated as being kind of the cream of the crop in terms of stock charts, are arguing for more of a consolidation in a leg down. Real quick, I want to, let's go to this tab, which isn't going to be updated, but it's going to make it easier for me to switch to the SPX tab. Michael asks, how will you know if primary wave 5 is done? When you have a move, a completion of a larger degree move, very similar to the drop that we had off of this top of wave 3, the drop that we had off the top of 5 of wave 1, the drop that we had off of the end of primary wave 3 back here in 2018, and the drop from the all-time high, previous all-time high as the top of that X wave, or the extension of wave 3, however you want to count that. Those types of reversals are usually either you have a very, very long-term rounding top and then it starts to break some support and then you start to accelerate down, or you have more of a blow-off top extension and then a sharp reversal. So we look for either, but primarily we're looking for agreement between different sectors, individual names, and then the underlying subwaves that argue for this being a more substantial top. When we look at the larger structure here, as we've talked about in past videos, I go to, I can get everything framed in on the daily. So we have our top of primary wave 3. This is what it's showing is the X wave. When you have the X or the B wave of a consolidation make a higher high, particularly in this case for our primary wave 4, counted this way off the 2018 high, where it's a substantially higher high, then that implies that the underlying trend is very, very bullish. So I know I mentioned that there's the risk of this being a fourth wave, or maybe this is just the 3 and it needs a 4 and then another 3, 4, and we can push this even a little bit higher, even in the more bearish case. But I think that when we take that all of the individual names into account, as well as the fact that this signaled to us that our primary wave 5 was going to be very, very extended, that we can still trust that this is the wave 1 and wave 2 of a very extended primary wave 5, or at least that it's the 1, 2 and the 1, 2. Move these a little bit more in line with what we're expecting into November, ideally. All right, so he says, so we do, somebody asked if we could post some of those cream of the crop, and mentioned the Stockwaves 300 and trying to narrow it down. Within the Stockwaves, Garrett and I have a list of approximately 300, give or take, usually a little bit more, names that we've kind of vet for quality of the Elliott wave structure and some other fundamentals and things that we look at in conjunction with Lynn, and just existing trend and their relative performance off of recent lows and so forth. Inside of using that as like a broader watch list, then we post setups, as they come along. And when we come into more significant bottoms, we post bigger lists saying, here's the 20 or 30 names that really look strongly like they're coming into making a low. So we certainly do that and we'll continue to do so. And that's something that we do as part of Stockwaves. So again, holding this as the larger wave 2 sets us up for even further extension in our primary wave 5. So a bigger drop down under the 3,000 level would actually be more bullish than counting this as the green 1, 2, 1, 2. Because if we were relying on that smaller parentheses wave 1, then our fib extensions might only take us into the 5,000s for a primary wave 5, Whereas here I'm using very conservative extension targets for the 3, 4, and 5, and taking this to the 300% overall, but that takes us pretty close to 6150 or 6200 for our larger primary wave 5 several years out. NG, Nathan, the move down on a micro level so far on the ES futures. Let's go back to the name. Well, let me do that. Yeah, let me do that. Even when I zoom in here, it's not clear. Well, actually, we got a fifth down here into the 355 close. So you could count this as 1, 2, 3, 4, and 5 waves down. So a corrective bounce this evening back up towards the 3400 region would be a pretty normal Fibonacci retrace as the first 1, 2 inside our C wave down. I'm going to scoot this over just a little bit, and then I want to end with this, and then we'll move on and talk about some of the other things that we go over. But our 5 waves down for our C wave should look something like this. Maybe this doesn't get quite as low, the third, if we're going to hold at the 100%, but this would take us closer to the 1, 2, 3, 6. And I think a test of that 3100 region, the 200-day moving average, would really be ideal in either whether we're counting this as the A or that wave 2. But now if we zoom back in, so our circle, this is how we parse things out by degree, guys. So our circle wave C that we were looking at, that ideally is targeting the low 3100s, should be a 5-wave move. That's going to be parentheses, lowercase Roman numeral, right? If your 1 degree is a circle, inside that, the next degree lower is going to be a parentheses. Inside that parentheses wave 1 of our circle yellow C wave down, we should have a 5-wave move. So this could be the 1, 2. Oops, don't move the whole thing. Just snap this over here. And so that will be without any parentheses or circle, just lowercase Roman numeral. Can be 1, 2, 3, 4, 5 inside that wave 1, and then we should get another bounce towards 3360 as the parentheses wave 2. So here's your initial setup for another scalp attempt heading down. If you're shorting for the entire thing, then you're in a speculative short now with resistance at the recent high. And then the more that this confirms, you can add for this leg, trim some profits. We get a clear corrective bounce as a fourth, trade this leg, trim some profits, look for that bounce. And then here's where you have a possible 5 waves down and 3 waves up for the 1, 2 start of the C wave down, and an even stronger setup for a strong drop. All right, did I miss anything? So Nico says, when do you see the bull market off the 2009 lows ending approximately? How long will this 5th wave last? So that's what we were looking at, what I was looking at on the other SPX chart. And again, Elliott wave is not as focused on timing as it is on specific price levels. But I use things like these Fibonacci fans and the general kind of slope that we've seen from other parts of the move to continue to fill out our target. And the slope generally starts to level out the further along you go. So you get, kind of get a stronger initial move, and then in the 5th waves, it starts to round out a little bit, particularly in moves like this back in 2015. So I'm looking at this move taking another 3 to 5 years from now, depending on, if we hold here as the wave 2, or if we're only getting the 4 or 5, it could end much, much sooner, but I don't think that's the case. So if we're in this green count and we're only going to get the move down towards the 3100s and then get more than the B wave bounce and start taking off then to our 3, 4, and 5 wave 5 targets for parentheses 3, then I think the whole thing can complete into 2023, 2024, maybe even sooner than that, but I wouldn't plan on it. I'm hoping that we can kind of have like a longer grind after we get our wave 2, ideally into that November election, that ends up lasting, you know, a good 3 to 5 years before we put in a much more significant top. All right. So ideally, the initial move down that we have today off of the high, as we just looked at, was a 5-wave move down. All right, let's move on to, all right, any individual stocks are going to be covered tomorrow in the Stockwaves webinar, or just in the, Stockwaves in general. All right, let's take a look quickly at IWM. I think IWM also has a pretty clear structure here as an ABC bounce to a 764 retrace in the move off of the August high, setting up for a measured move down towards the 140s. 144 down to 140 is going to be the ideal C-wave extension target for that move. It is still possible that this was a B-wave in IWM and that this is still going to bottom sooner in a more complex structure there. The Nasdaq, I think, is more similar to the S&P, although there is, oops, it's not going to like going to a 3-minute. It didn't hate me too much. So again, we have the same yellow B-wave structure, setting up for either the A of our wave 2 or the 2 of the 3 already in green. And there is a little bit more of a chance, because this got so much higher, that this could be a 4th wave. And then it comes up here for the 5th of a 3rd, and then fades as another 4th, and then tops out sooner than the market. But we're going to kind of go roll back and forth between those potentials as we see what the subwaves off of each move are providing. And you know, there's always going to be individual names that will support one thesis more so than the other. And so if that's what you're looking for to happen, then you focus on those names, then more strongly present that. So earlier this week, because we saw this filling out on a lot of individual names, I noticed the NVIDIA chart really looked very strongly like this structure and was setting up for a very good risk reward for the measured move down for the C wave in a similar structure. It just so happens that I think NVIDIA, this is a 3 and this will be a 4, but the same ABC structure off of the high for just that A wave looked really, really good. So highlighted that. Zach, are we still looking to test the 2900 region in the C wave on the S&P? So I think first, the most immediate move that I see, similar to this, what we're looking at here on the Nasdaq chart, ideally is targeting the 10,500 to 10,000 level. On the S&P, that's the low 3100s. So to get lower than that, we're probably going to need to see a B wave bounce and then head lower from there. So I would, you know, if we see 5 waves down completing into here, this is a bullish setup. Even if ultimately it's only going to get a B wave bounce and then head lower, I wouldn't be holding on to shorts and not adding any longs because I want to see a lower retrace in the 2900s, even though it looks like we should get an ABC down there is my ideal. But this is an opportunity to add, and then if you clearly see that it's a B wave, then you make adjustments and then add back on the C wave down. All right, let's shift gears a little bit and go talk about energy names. I have this yellow wave 4 on my chart. because there are a lot of energy names in the individual energy stocks that Garrett and I follow where the move off of the April extremes can be an ABC move up for a fourth wave in those counts. So even though this looks more like 5 waves up, you can see that we only recently got a little bit past the 1382 extension for what would be the third wave here. Even if we move this third wave up to here and count this as the 4, we still have this very, very weak ending diagonal for the possible fifth wave off of the low. So as a more bullish wave 1 and getting a wave 2 retrace, it's not as the oil chart itself, the oil futures, in my opinion, does not make as strong of an argument. I'm certainly giving it the benefit of the doubt, though. But what I see off of the August high, though, is a very similar potential for this to be an A wave, this to be a weak flat for the B wave, even though I say weak flat, but a lot of energy names were up a good percent today in the end of this C wave of the B. But set up for at least a drop down towards the lower 30s as what could even be just the A wave. I have the Fibonacci retrace of this entire move from the April low. Because that was so extreme, this is only a 23.6% retrace. The 20s are only a 38.2% retrace. So an ABC to the 38.2 is kind of the minimum level that we look for in terms of a normal retrace if something's a more bullish wave 1 and wave 2. So I do think that there is some significant risk for some charts in the energy space. A lot of the energy names that we follow in stock waves were showing significant divergence off of these highs. And this move looks like the top of a B wave in here and a 1, 2, 3, 4, and those need a fifth wave down of a C. But that final move, I cautioned, could start to accelerate, particularly if we're going to get a C wave down towards the lower 30s in oil. So I am very, very concerned about that. I do see there is some potential for something more bullish to play out, but so far I see only 3 waves up and the potential for a bigger drop. I actually haven't looked at natural gas in several days. Oh, but look at that. Natural gas, on the other hand, looks like we got a little bit wider here for the B wave. This is zoomed in at a smaller level, so I'm ignoring a lot of prior data on natural gas because I just don't trust the pattern as being part of something at a larger degree. So I'm only looking at the structure off of that June low. And off of the June low, I think we have what counts as 3 waves up so far, holding into ideal support in the 220s here for a fourth wave, setting up for a fifth that should take it into the 290s to 3 region. So there is a very, very nice setup here in natural gas for that to be a little bit more immediately bullish. But when we draw our fibs for this fourth, there is room for the fifth of the C waves to stretch down closer to 209. Much below 209, and I think that this is not as bullish as it was making it look like. But this looks like a pretty perfect ABC structure so far, setting up for that move higher. So I'm going to start keeping a little bit of a closer eye on natural gas again. VIX is not something that I normally cover I think I was using the BATS chart. Oh no, maybe I was using the Amex. I think it's very hard to trust long-term trending on VIX because it skews to the downside. So we have an initial move off of August and a very, very deep retrace, but it didn't make new lows. So I would be looking for a possible measured move, at least taking us back towards the low to mid 30s, maybe higher. Ideally, maybe that is an A. and then we get a B wave, and then a C wave down that doesn't get fuller extension. I think a lot of times you don't quite see the same kind of extension on the later move in the VIX as you did. Oops, didn't mean to make that white. Move this yellow. There we go. Okay, so that's kind of I think there's a common misconception that the VIX is an inverse of the market. I think it does play, it does seem to sometimes play in opposite moves of the market, but the magnitudes are definitely different, and it has its own different counts and characteristics. All right, so that was energy names. Let's move on to the metals. There we go. All right, so in gold, off of the 2015 low, I think we are still trying to complete the top of a primary wave 3. So the fifth wave of that started back in March, the March low, and I think it is filling out as this ending diagonal that we've been tracking. So this was an ABC move up for wave 1, even though technically it looks like it could count as 5 waves up. The character of the subwaves and everything that we're following along the way looked like an ABC move. Typically, when you have an ABC move up for wave 1, you usually have a little bit of a deeper retrace, but we did get a pretty wide retrace for the wave 2. And the C wave, or the third wave here, does count very, very clearly as an ABC structure up into normal fibs that we would expect for the third of a diagonal. We have an initial drop down that was into proper fib support, but again, a little bit too sharp to trust as all of the wave 4, so more likely just the A wave. Since then, we got a high that could be the B wave and are trying to form an ending diagonal for the C wave down. But as we've been discussing in the mining stock service the past couple of days, we can count this structure as a triangle. So this B wave moves over to here. So we have the A wave down, then we have a B wave triangle. So that's A, B, C, D, E for the purple B wave. And that is hitting resistance and now trying to start the C wave down of our wave 4 towards the ideal 100% extension. And we're going to continue to measure the 100% extension off of the high that was struck, not off the end of the triangle. So that's going to give us still the 1850 to 1820 region is ideal support for our C wave down. Whether we continue to fill out as our ending diagonal, which I think is a little bit less likely because this couldn't turn down from here, even though technically it didn't invalidate. I'm going to be looking for a new 5-wave move down from here just to complete as a purple C wave of 4. Then, because the entire structure in gold that we're looking at is a diagonal, we're going to be looking at an ABC up for the 5th wave. Because our third hit the yellow 223.6% in the fib extensions for primary wave 3, we're going to be looking for a new high to at least that next fib, which puts us in the 2160 region for the top of that wave 5. I am not going to go over and do the same on the GLD. I prefer to look at the futures, the same reason why I like to look at the ES futures, because it trades more hours. There's a lot more dollar value and volume that trades on the gold futures. So I think it is a much more reliable chart than looking at an ETF that is meant to track it. Silver counts a little bit different, but the same potential structure for an A, B, and a C of a wave 4. It just looks more clearly like it's holding as the 1-2 start of that C wave down. Off of the March low, though, it's not a 5th wave. It is potentially either a C wave up, which is very bearish, or 5 waves up trying to complete for wave 1. I don't think you have to panic and don't need to start shorting like all get out as it looks like we're trying to complete the fifth wave. This fifth of the five is very likely to extend and probably head towards the 37 to 40 region, regardless of whether it's a C wave or a wave one completing off of March. And I think it's better to look for some initial structure off of the high and then look for how that's filling out. Is it looking like it's setting up to be a corrective retrace back to the 20s, which would be very, very long-term bullish for silver? Or is it setting up and starting something that looks a little bit more violent as an impulsive start to a move to the downside? And then evaluating from there. We're certainly in our mining stocks portfolio, we'll be taking, trimming lots of profit from names that are more at risk from a more significant top in silver, as well as, we're looking for that ABC up in gold to be completing a pretty large primary wave 3 as well in some consolidations. So we will be managing that prudently as needed. Zooming in a little bit more to the C wave down, as I said, it looks like we have a wave 1 down here and an ABC bounce for the wave 2 to just shy of the 618 retrace. So far, we only have 3 waves off of that high. But when we do have what looks like a 1-2 start at the larger degree, then a lot of times we can give this a benefit of the doubt of maybe being a 1-2-1 kind of start to something that just starts to let go and drop more rapidly for the rest of that C wave of 4. The ideal target is in the 23 to 2270 region to complete that C of 4 and set up the start of the fifth wave. So yeah, I do, Etain, I do see 5 waves up potential, but I think we're still in the 4th wave of that. So we need a 5th wave up after this consolidation completes. Now moving over to GDX. GDX kind of getting stuck in between those potentials that we looked at on silver and gold in terms of the consolidation off of the recent high in August. So I think that this is the initial move of a corrective retrace, and that this is part of the corrective consolidation within that corrective retrace. And so we are set for an attempt at another leg down towards the 37 to 34 region. That can count a number of different ways, but I think ultimately we have corrective consolidation here, setting up for another leg down. That low, it doesn't really matter, in my opinion, how you label that low. As we saw, that should be the 4th wave of a 5th wave that's targeting at least a new high in the gold and silver charts. In the miners, there are a number of miners where this counts as wave 1, 5 waves up from 2020 for wave 1 of a larger third, and this is an A, B, and needing a C of wave 2, or even an ABC for just A of a bigger wave 2. GDX got too far in terms of the fib extensions off of the March low for a primary wave 3 to reliably still consider this just a wave 1 and a wave 2. Other things also can count as a wave 1 and a wave 2 here, but again, GDX and then another 1-2. But again, GDX looks like it's too far ahead for that kind of account to be reliable. But that doesn't mean that that isn't the most valid and most realistic count in a number of those individual names. So again, a lot of those individual names that we follow in the mining stock services are going to be completing wave 2s into this drop. And those are going to be some of our prime candidates for playing the next move higher, even if it's only a 5th wave up in the metals, even if this is only a 4th and it's getting a 5th wave up inside the 3rd in GDX. Even if this is only an A wave and it's only going to get a B wave bounce in a wider consolidation of one of those. Whatever this low is, there's going to be some tremendous buy opportunities here. And if it clearly shows that it is only a B wave, then we take the profits from that move. We trim, we tighten stops, we hedge a little bit as needed, and adjust for the potential to get that C wave down. But On the chances that this is all of a fourth, or this is all of a two, or all of an even bigger parentheses two, we certainly take this setup very, very seriously. This is going to be a tremendous opportunity to go long. Again, like we're looking at the structure in the S&P, that there are a number of different ways to count this corrective structure. You could even count this as A, B, and then 5 waves up for the C wave of just a wider flat for this as a B instead of an X, or WX, and then this is an A, and then the B, and you need a C wave down or the Y wave. A lot of different ways that you can count this. I think it got too high to be for a triangle, and that this drop was actually too strong and this not high enough for it to be a whole triangle for the fourth wave. So I'm looking in most of the charts, if we looked at a lot of individual miners charts, which we do in our Monday videos and our once a month webinar in the mining stock service, so many of those look very, very clearly like an ABC bounce as a B wave off of a lower low that they made here in later August. So I think that there's enough risk to take this potential drop seriously. But as this move unfolds, however it fills out for a completing, whether it's a C wave, whether it's a Y wave, we'll consider all of the possibilities and weigh those in with the individual charts that we watch. This is going to be a tremendous opportunity to go long. And we have some really nice targets for individual names that we think have a lot of outperformance potential that we are keeping a close eye on in our mining stock service. Again, Brad, so as far as timing goes, I make some efforts at timing, but Elliott Wave is far more concerned about the structure of a move as opposed to the timing of the move. But that said, it does look like we really should be completing a move down unless this really drags out. It looks like it can complete into the front end of September or front quarter of October and start the move up for the fifth wave. Ray, I'm not sure what you're asking as far as selling the GDX then. I mean, I'm very, very long miners, but in our mining stocks portfolio, we have raised some cash into the July and August highs and have been patiently waiting for, we added some things on some of the drops. We have some other positions that we've added for some different ancillary plays, but we do have some hedges and we have a good amount of cash ready to make some buys, but we're still very long. So it's not like we're out of any miners exposure because we're looking for more of a consolidation. We've just reduced our exposure and are looking for good opportunities to add back to that. All right, what else? Oh, let's look at some bond action. And then I think that might do it for us on time. All right, so as we've discussed before, we are working on a potential very large degree. I'm going to go to 6 hours so I can fit everything in, trying to form a very large degree top in treasuries. And it is possible that this was the top, but the way that it held as a corrective consolidation into the March low and got 5 waves up off of that low really has a strong setup for potentially higher in an extended C wave of this cycle degree wave 5 for the 10-year treasury. We were looking at this awkward structure as a possible leading diagonal. So in early August, we were looking for a possible retrace to our ideal fib support region as the wave 2 inside our green bullish wave 3. Zoom in on that a little bit more now. But so we did get that move. It was a little bit sharp, but we could count it as a 3-wave move down with some particularly in TLT and the 30-year, which we'll look at in a minute, getting a nominal higher high here. But when it couldn't hold this initial support, it was setting up for a potential move down lower. The problem is that this retrace in the 30-year and in TLT had already come down to a deeper retrace, so it didn't have as much room for the alt wave 2. But the 10-year is still continues to hold in a little bit what looks like a more bullish posture. This does not look like an A, B, C up for this B wave, but the way that it started to move down did make this a risk. So there is a risk that this is an initial move down and that we're getting a corrective retrace as a wave 2 in that orange move, and then we can have more of a drop. But you'll see when we go to the 30-year chart in just a minute, that looks like much more of a risk on the 30-year. I think the 10-year treasury chart that we're looking at here has a little bit more potential to count as just this alt low here. There is still some risk that it tries for a deeper retrace, but I think if it were to drop down here, it's possible that the 10-year holds the 137s as support, but this comparable move would invalidate a 1 and a wave 2 in the 30-year. So I think if it's going to hold, I think they really need to hold the recent lows. This is the 138.23 level, and start to break over some resistance to be significantly bullish again. And it would be pretty bullish if that is the case. But I think this is the type of setup where, if you want to nibble a little bit on the long side because you like the potential, that you have strong stops at these two recent lows. Or you can just treat it as a breakout. If it gets over 140.13, then it really should continue going towards 142.27 and 144.1. All right, the 30-year, we can see, we're zoomed in a little bit much to get a good view. We can see that same potential green wave 1 and wave 2 at the parentheses degree, that choppy structure that we are counting as the leading diagonal, a good A, B, C move down into a 50% retrace, what looked like a good 5-wave start to our heart of our third, but then it got a deeper retrace. So this came between the 618 and the 764. It is valid as the alt wave 2, but because this got a more severe drop than what we wanted to see for the 2 inside the parentheses wave 3, we have to consider that this is an ABC down for the orange wave 1 of this orange C wave, and that this is working on a corrective bounce, which as long as it holds the 179 to 180 resistance region, can be set up for more downside towards the lower 160s in more of this orange ending diagonal. If it starts to accelerate as it gets through this 179 to 180 resistance, and certainly if it gets over the high that was struck earlier in August, then it should be a breakout fully into the green count. So if you like the potential for the green count and you trust this move as the alt wave 2, then again your immediate supports are the 174.26 and 173.280 as your immediate supports, or you can wait and see how that looks as it's heading up through the 179 to 180 region, or even trade that as a breakout. In this zone though, it's very, very ambiguous. Again, with USO, the same way I don't look at GLD. TY is going to be the inverse. It's the ZN futures. I don't know why IQ Feed codes it as TY instead of ZN, but that's what they do. The bond prices are an inverse of the yield of that TNX. I don't look at USO for the same reason I don't look at GLD. I think the futures give you far more data, are traded by more people, so you're getting a more accurate representation of the underlying structure. I know some people that do trade USO though, So they apply a count on USO because that's a vehicle that they use for trading. But I think that there's often a little bit of a disconnect, and I like to look at the price data in the futures instead. Garrett, the way you're showing in the bonds, that exactly tells the next year is going to be deflation bust. I'm Zach, by the way. So I don't want you guys to read too much into correlation arguments. We try and look at each chart on its own. You know, for any chart that people make an argument that it correlates to equities or it correlates to metals prices or whatever it is, you know, we can show periods of time where it clearly did not, or where, you know, they moved in opposite directions or they moved in lockstep. So correlation arguments work until they don't. It's much better to treat each chart on its own. The only caveat to that is that things that are priced in dollars tend to react when there's significant relative movement to the price in dollar. Cam asks, Zach, I see you use hourly 1, 2, 4, and 6 time frame for different charts. I also use daily, and I use 30-minute and 15-minute and 3-minute and 5-minute and sometimes even 1 minute. But yeah, on what basis do you pick the optimal time frame to use? So there's some indicators on all of my charts. Let me go quickly jump over to TLT where it might be a little bit easier to see. All of my charts are going to have these little flags here. They're going to have the green dashed line, and the flag over here will be the price where that currently is. Those moving averages are simple moving averages. The red is the 200 daily, the green is the 100 daily, and the blue over here is the 50 daily. And those are going to be on every time frame, daily and below. Those are going to be the daily moving averages. And the Bollinger Bands are for the daily chart as well. There are some indicators that I use that I look at on different time frames, and so those will change with the time frame. And then there are other ways that I look at when I want to show something. A lot of times I'll decide, well, I want to show as much detail as possible, but I also want to show context of something. So when I decide what time frame to use to frame it, you know, is a trade-off of how much price detail and wave count detail do I want to try and show versus how much context do I also want to try and show, both prior price action and potential future price action. So sometimes I might present something where I want to zoom in on just the hourly because I want to focus on, you know, the structure here, and maybe I'll frame this so that you can see where the green 3 is pointing if it gets over that resistance. And sometimes I'll want to zoom in even more and focus just on the price structure here to say, all right, you know, as long as this low is holding, you know, the 62 region, 61.89, then we have a possible 1-2 start here to a C wave of at least that wave 2, if not maybe something more bullish. So there's your good risk reward play on TLT in terms of an ETF that is stuck in the middle between those 30-year and 10-year bonds. I wouldn't read too much into further downside in yields relating to mortgage rates. I think there is kind of a realistic floor for mortgage rates, whereas bond yields could even go negative. We've seen countries end up paying negative yields. It's murder on a lot of banking institutions, but at no point are mortgage rates going to go negative. The bank is never going to pay you to have a mortgage. So there are costs involved and risks that they're taking on that are being calculated into mortgage interest rates. That's a premium on top of whatever treasury yields are. But I don't think those are going to realistically be able to get much lower. I think in the high 2s is pretty amazing for a 30-year fixed. All right, and somebody requested to look at the DX. I think we do often look at the dollar. I'm not a fan of the subwave count. Oops, something weird's going on with my price data there that I can't zoom out at the moment. I have to fix that. I think that the March peak that the dollar hit was a more significant top for a while in the dollar. Certainly the way that this moves up off of that low could change my view on that if this looks like it is setting up more than just a corrective bounce as a B wave, and starts getting over the 90s, then we have to realistically consider that it might break over the 104 and continue to extend significantly higher. I think that this is a little bit further extension of the C of this wave 3 here, and that this is a 5-wave move for our A wave. And so I'm looking for more of a bounce in the short term as that 4th wave, and then at least a nominal new low. It's already extended a lot, so I'm not looking for too much extension in the 5th wave down. And it certainly is possible to argue for some version of a completed count for the A wave here, maybe as A, B, and C, even though this looked bigger than this B wave. But I'm looking for at least a bounce as that 4th wave, and maybe that 4th wave is the A wave of this B if this was the blue A here. So that would be A, B, and C wave up off of this low instead of a 4th and a 5th, and then an ABC bounce. So that's what I'm looking for in the dollar. And again, this could mean a little bit of headwinds for a lot of things that are priced in the dollar. It doesn't necessarily mean that they have to move in an inverse manner completely, but it does mean that that can be some headwinds that they need to consider. All right, Jatine, I'll try and I'll do a screen grab of the TLT chart, and I'll post that in a beginner's circle post. All right, we'll go ahead and end there, and I will get this uploaded for you guys, and I'll see you next time.